Welcome to our global market forecast, brought to you by Options21. After looking at the indices today, we'll do a special focus on gold. Let's start once again with the S&P 500 and consider price action that we've been observing over the past month. Probably the most notable feature of this particular market at this present time is the fact that it has completed an accumulation phase, broken over its neckline in the context of an inverted head and shoulders pattern, and continues to do a series of higher highs and higher lows. This market appears to be all set to break into a new highs, and I've just blown up the recent price action in the last week, and you'll note of the close of business on the 23rd, we've had a very large break to the upside. Now, I just need to just give you a warning here. Large break to the upsides often suck a lot of traders and a lot of investors into buying into the market. There's an issue that I have, though, with this particular move, and that is that the extension currently, based on previous extensions, I'll show you in a moment, is more than 100%. In addition to that, the price action is way above that thin blue line called a 20-period exponential moving averages. Correction, 20-period exponential moving average. Once the market gravitates too far above this average, what you may find is the market will revert to its average by it coming down. And I'd say to you that's a very likely probability. Just picking up my comment that the market's it's done a greater extension than its previous extension. I'm just going to use a tool to measure 100% of the previous extension and mark it up for the current low in late March. And we'll see, as of last night, the market closed above this 100% extension. The significance of that is, in conjunction with its positioning above the moving average, and in addition, it's done it on low volumes, what you will find is that it has got a high propensity to revert back to this average. When I say low volumes, it's declining volumes. Of course, there's volume driving the market, but the market last night, in the last session, moved up with declining volume. In addition to general declining trading volumes, I could see the advancing and declining numbers of the S&P 500 have declined from last week. 3 weeks ago, within the S&P 500, we had 293 advancing, 180 declining shares. Last week, we had 266 declining, 266 advancing, 208 declining, and this week we've got 256 advancing and 218 declining. So the past 3 weeks, the market is going up, but the advancing stocks within the S&P 500 are getting smaller and smaller, and the declining stocks are gradually getting larger in volume, larger in number, and larger. Another very important point is not the numeric value of the advancing and declining stocks, it's the volume of those stocks. Last week, the volume of advancing over declining was 24%. A week prior to that, it was 66%. Then it declined to 24%, and then it's gone to 14% this week. So we're seeing from last week, 24% more advancing volume. This week, only 14. This is pretty important stuff because it backs the picture of a market that's rising with declining volume. So there's no major volume driving this to continue on up. Of course, the market is in an uptrend, but markets don't continually go up every single week, and you have to expect a counter trend, and I would expect a counter trend probably within the next 5 days. There is another natural line of resistance on this screen, which may not be totally obvious that if you're new to the markets, but it is at old highs, and we are very close to old highs, if not there already. So at this point, There is usually a lot of selling behavior kicks in at this point, and you see the market pull back before it breaks into a new high. Once it does break into a new high, you should see an acceleration of buying behavior, and the market drive up to the probably the focus or the forecast price that I put on this screen last week. The message of all indices around the globe are that they're all synchronized to the upside, and it doesn't matter which country I look at, we're in a strong upward move. This is EWG, the German chart. This is EWC, the Exchange Traded Fund, representing the Canadian chart. Strong upward moves. This is the Shanghai Composite, which happens to be the strongest index in global markets at this point in time. The second last chart I'll show you is the Australian market, Asia Pacific, once again making very strong breaks to the upside and continuing to break into new highs since last week. Last of all, because Brexit's topical, just putting up the UK chart, EWU, which is United Kingdom, an exchange traded fund traded on NYSE, strong upward movement on this particular chart, a series of high highs and high lows. Has lost a little bit of momentum in the past week, but continues to trend strongly to the upside. Okay, we discussed having a focus on gold this week, and we can note this is the GLD, the Exchange Traded Fund representing gold. We may note that gold had a major low in July of 2018 and has progressively had some major gains into 2019. But very recently, and that is in the last 3 to 4 weeks, something's changed that uptrend into something which is quite negative. Let me show you. Okay, I've switched the chart over to a daily chart, and we can see that rally that we've had September, October, November, December. We can place in a trend line of best fit, if you wish, and we first of all make note that that trend line was broken approximately around the 28th of February 2019. The next notable bit of information on this screen is the market, after breaking trend and trading below its 20-period moving average, started to revisit its high. That revisitation of a high, but failure to take out its previous high, is a very negative signal. And then the market fell and traded, but did not close below what I call the midpoint of an M top formation. So we've got a high, a lower high in the context of a broken trend. The market then rallied, and on that rally, it failed. That failure confirms a MA pattern, and it's at this point where you usually get a large decline in price. Is there anything that could save this particular contract? Well, the only thing that I can look at to give me some sense that the market isn't going to fall is to look at institutional buying and selling behavior. And what I see in this chart is an acceleration of selling behavior from last week. So the market has declined over the past, say, 4 weeks, and increasingly, as every support level has been hit, there is an increase in selling behavior from institutions, which tells me the most probable outcome of this particular chart will be an increased movement to the downside. Because it's confirmed an M top and has broken trend, it would have to go through all the elements of accumulation before we could start to think about the market moving back to the upside. One final piece of information which would support the contention that gold is to continue down is to look at the US dollar or its different derivatives, such as the US dollar index. The US dollar index is a index of US dollar against a basket of currencies predominated by the euro. But this is in an upward trend. And the significance of that is, generally speaking, gold and the US dollar have a negative correlation. Not a perfect negative correlation. I think at the moment it's 0.3 or 0.4, but it can be as high as 0.6. Therefore, just depending on how we look at the gold contract, whether we look at through pattern, whether we look at through institutional volume behaviour, or whether we look at it as a pseudo currency, it all looks negative. If you wish to contact me anytime, you may do so at paul@options21.com.au. That's paul@options21.com.au. Or if you want to call my Australian number, it's +61 08 9307 8261.